Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing in that order. Today is Friday, November 22nd, 2024. Today's episode, we're going to start by talking about the Fed funds futures looking higher for longer. Didn't we already go through that phase? Didn't we get to the point where the Fed had made a 50 basis point cut, suggesting that, we're headed into a stronger cutting cycle than previously expected? I mean, maybe I'm not the only one out there looking for a black swan that hasn't yet come. And so, Fed funds futures can allow for the idea of a higher, longer cycle. And, seeing as though the yield curve's been inverted for like the longest time ever, we're talking about over 2 years. If it is higher for longer, the eventual outcome is going to, in my opinion, be even a greater disaster. Taking a quick look over at the CMEgroup.com website that shows us the probabilities of future Fed rates, we're now pricing in only 2 cuts for the foreseeable future, all the way out through December of 2025. Before the first cut, we were seeing within a year a total of 6 cuts, and we already had our first 2, so now we only have 2 more, removing 2 entire cuts from the foreseeable future. Combine this with the fact that junk bond credit spreads between junk bonds and treasuries being at historically tight levels at 2.61. Again, if we zoom out on this chart, I show this often because it's very important. It's extremely rare and strange for credit spreads between junk bonds and treasury bonds to be this low at 2.61%. As you can see, it happened in 1977 for a brief moment, 2005 for a little bit, 2007 for like 1 month at 2.46 right before the great financial crisis. Remember, folks, when the market gets like completely comfortable, all the bears are dead, and everyone believes, hey, the market's going to be fine. That's when things are actually like kind of allowed in a strange way to totally fall apart. You can see all of these, all of these lows here from 2011 through 2016. We got to a low of only 3.5%. And so we're right now being 2.61%. Again, this, also add all the daily reminders of the S&P 500 trading at a PE ratio of 30, the CAPE ratio being at 38. The market has zero fear right now. They think that the economy is going to be just so strong, and maybe it will be, but I have my extreme doubts. All in all, there's no black swan yet, and so we can, for the moment, believe that we can be higher for longer. Next on the agenda, Synapse. What's that? Synapse is apparently a fintech where people had put their money and apparently is not, doesn't have the same kind of backing as your normal bank. This counts to me as a bank blow up, by the way. Thousands of Americans see their savings vanish in Synapse fintech crisis. When I look into my crystal ball, I see more and more of these coming in the very near future, but that's just me and my crystal ball. Next on the agenda, Bitcoin hit a high exactly today at $99,800 and 0 cents. This is a very interesting, very even number. At some point today, one person decided to sell their Bitcoin and put a price at $99,800, and another person decided to buy their Bitcoin from them at $99,800 and $800. And since then, it's gone down a little bit. I'm kind of wondering if, we pretty much have to get to 100,000 now, right, guys? I don't know. I'm kind of wondering in my crystal ball why we didn't get at least to like 9,900, because then you'd at least have the number of the devil upside down, right? It'd be nice It'd be actually very poetic for us to get to that number before getting to the longest, deepest crypto winter in the history of the world. But yeah, anything can happen with Bitcoin and other cryptocurrencies. While we're on the topic of cryptocurrencies, there's a nice chart called Total 2 Crypto Cap on TradingView. This shows all other cryptocurrencies, not including Bitcoin combined, the total market cap being quite high, much higher than it's been in a long time at 1.3 trillion. I bring up this chart only because it's interesting to me that from beginning of 2018 until around the beginning of 2021, we had this, you could call crypto winter here. If we take that exact length from the top of the bull market in 2018 and measure it to the next bull market, and then we drag it to the top of the most previous high, you can see why chartists might be excited about a potential another run to the upside in cryptocurrencies. I definitely think that can happen, but I just want to bring up one other, potential scenario. Just going to drag this right down here, and I drag this right over here. Well, what if this is, the ultimate head and shoulders top, for people to realize that at the end of the day, it functions more like a Ponzi scheme than anything else, sending the price to practically zero. At this point, nothing will surprise me in the crypto market. I could see the market cap go from the current 1.3 trillion all the way up to 20 trillion, 30 trillion, who knows. I could also see it going down to like absolute zero and all of these cryptocurrencies collapsing completely. I don't know what's going to happen with this, but it is sure fun to watch. Last headline of the day from Robschild video is the yield curve and stock duration. I want to talk about that just a little bit. I find it very interesting, the shape of the U.S. Treasury yield curve being higher on the 20-year and dropping significantly to the 10-year and even more so to the 5-year, and then from the funds rate all the way to the 5-year completely inverted still. From the 5-year through the 30-year, this is what it's really supposed to sort of look like. Is it's supposed to go up, because when you lend your money for a longer period of time, you typically will ask and receive a higher rate of return. That's what a normal yield curve is. An inverted yield curve suggests that the Fed is, offering a higher rate for people to, encouraging saving money and discouraging investing money, offering a higher return on your cash than you can get for lending your money for a longer period of time. One of the parts I kind of wanted to talk about was the difference between the 20-year and the 30-year, actually. Notably, this is inverted here. In other words, investors need a higher rate of return over the next 30 years, but are willing to accept a slightly lower return for a longer period of time. So what's up with that? Additionally to this, stock duration, what's that? Stock duration is infinite. It's infinity. When you own a stock, it's forever. It's not practical really to think of a stock as lasting forever, but it does last forever. As long as the company exists, the stock exists, you still hold that portion of the company. And, what the interesting part of this that I'm trying to say is that, with the 20-year being higher than the 30-year, think further out, think 50 years, think 100 years. If we continue that downward trajectory, being inverted for a longer period of time, it just shows that the market is expecting much longer term, lower rates of return, which is consistent with the past 700 years of how the world's working, with technology, with the ease of access to credit, the ability for people to borrow and pay back with higher surety, I guess you could say. With technology, with medical advances, people living longer, the expectation, over a very long period of time, we're talking like, I think 700 years to 1,000 year history, generally rates have been going lower and lower and lower over time. And that could actually help explain the fact that the PE ratio of the S&P 500 is currently at 30, although, like I keep saying, the difference between the 30-year bond right now and the PE ratios, it still doesn't make sense, because at the end of the day, if, it is true that stocks deserve that higher valuation because of lower future returns past 30 years, then it doesn't really make sense for someone to not be invested in bonds instead of stocks at this current point. Because as long as you believe that rates will be generally going down, the safer, higher returns exist in bonds over stocks at this current point. That's at least the way I see it. Another part of this U.S. Treasury's yield curve that I just want to point out is simply that the 3-year and the 5-year offer the lowest yield across the entire curve right now. This is while the fund of HYG, a junk bond fund, has that same duration of 3 years. Meaning, in order for junk bonds to gain value off of yields dropping, you would need to see the already lowest point of the curve to drop lower, giving stronger weight to my whole idea of shorting junk bonds at this point. I love holding puts on HYG right now, as far out as a year. Eventually, I might be looking at even further out, or rolling them over just to keep a year duration on them. There is the carry cost, but I think it's worth it with credit spreads being so tight and this part of the yield curve already being the bottom. Before we go through the rest of the charts, these are the daily reminders. None of them have changed today. If you want to hear me read through my daily reminders, always watch Monday's show. For this week, that would be November 18th. And it's the one that looks like it has a yellow castle in the ball with snakes around it. With none of the daily reminders changing, the crystal ball readings remain as that fact that I believe that the S&P 500 is currently priced like it's a Ponzi scheme. There is a bear market imminent at this point, and that the Fed won't cut fast enough to save the economy, even if they try. And I have my doubts about them trying this cycle, considering inflation and some other factors. One last thing before we get into the charts, Market Watch. Today's data is right here. The first number is the actual, middle is the expected, and the right side is the last reading of this. Basically flat across the board. Consumer sentiment coming out a little lower than expected, but not the black swan event that the market kind of needs to wake up from its, complacency stage, we'll call it. Onto the charts, starting with the S&P 500, the SPX closing slightly higher today. I mentioned yesterday, I don't know where Mr. Market's, I have no idea where Mr. Market is willing to go from here, but I favor the view that it will go to the downside based on all of my macro views and, basic valuation moves. It's not just macro history, it's Ben Graham's investment philosophy that's playing out here. When you have a market that is trading at such a high PE ratio, while bond yields are not insanely low, it's a big mismatch, and I still expect the S&P 500 to roll over. The higher it goes, the higher expectation I have of it rolling over to the downside. But Mr. Market, I can't control what my neighbor and some other person decides to make an agreement that they're going to sell. One guy is going to sell to another at this price that it's at right now. Okay, well, good luck to both of you. Yeah, that's it. The 10-year Treasury note yield still fighting the battle at this head and shoulders top retest line that begins in 2021. I'm bringing this up on the show a lot because it's very important. It affects me personally as I have over 55% of my own portfolio exposed to long duration treasury bonds. My expectation is for yields to roll over to the downside here. Again, with stock valuations being so high, it would only make sense for things to balance out one way or another, and bond yields go down would be one way. Another thing that I keep bringing up on every show lately, because it's one of the most interesting things going on, is the 10-year break-even inflation rate. While some people are, piling into Bitcoin because they're afraid of further inflation, the big money, the people betting enormous amounts of money on what the inflation rate will actually be over the next 10 years, is currently sitting at 2.34, going abnormally flat. If you zoom out on this chart, although typically it stays within the range, which is the Fed's target of 2%. Sometimes it's higher, sometimes it's lower, but it doesn't typically go flat forever. I mean, we see times where it gets as low as 0.15% expectation, and sometimes it's pricing almost 3%. So, where are we headed? Are we really headed into, higher inflation period, or disinflationary, recession/depression? I mean, if you take a look at history, it pretty much always goes into the deflation camp, especially taking into consideration demographics. We don't exactly have super high birth rates, and with the current administration, being a little less keen about having people come into the country willy-nilly, we'll call it, at least in the US, I don't see where the inflation is going to come from, the real inflation. If you want to get super deep into that whole argument, one of my favorite people to watch, if you don't know about him, is Jeff Snyder. His YouTube channel is called Eurodollar University. Fascinating stuff over there. Next, TLT, my favorite place to be. Coiling up here a little bit. Looks like we're wanting to, whenever any market coils up, eventually you get a breakout, and the longer you coil up, the bigger the breakout. From a basic charting perspective, this red candle, and these days all being considered inside days, the likelihood would be to break actually to the downside. Although we do have this divergence in the RSI in price, the RSI having higher lows and higher highs, while the price having lower highs and lower lows. Also being a descending broadening wedge at the bottom of a recent move down suggests that this wedge will eventually break out to the upside. But we could have a situation where this plays out to the downside, maybe to the bottom of wherever this ends up, before going back up to the peak and breaking out higher. It wouldn't be surprising if that's how it plays out. HYG, my favorite place to short. I have long dated puts, leaps on these, you can call them, just going sideways here. Again, notably, you have periods where this can go up and up and up, and you have periods where it can go down and down and down. This is not typically the kind of market that can go sideways forever, and it's based on the fact that credit spreads are, as I said earlier in the show, are historically tight right now. Combine that with the fact that the duration of the yield of this fund is the lowest of the entire curve, suggests to me that I can't see how it can possibly increase in value right now. So the only question to me is, how long are we going to go sideways before we break down in this fund? That is, unless all yields somehow drop. It just doesn't make sense. Again, shorting junk bonds right now is like heads I win, tails you lose kind of situation, because in order for yields to go up, it means that the economy is doing well, but that puts pressure on junk bonds, both in terms of the price because yields are going up and the spreads potentially widening. And if yields are dropping, it means that the economy is seeing weakness coming ahead. which would also spread credit. It would spread the credit spreads, between junk bonds and treasuries. So I feel like I have the odds stacked in my favor, and I'm excited to see this market roll over to the downside. Another area I've been bringing up on a daily basis is DXY, the dollar index, just going on this monster tear to the upside, peaking out today around 108. Again, the higher this goes, the more dangerous markets get. An expensive dollar worldwide economically can be a very dangerous thing. Notably, though, we have this big wick on the top of the candle, which suggests that, it's not as strong as it could have been. The sellers are not, they're not dead. So we may see a pause here based on this wick. I'm not really sure, but from a longer time horizon, it looks like this just keeps wanting to go up, and I have no idea when it'll end. And if it doesn't end, if we just keep going up, this could, like I'm saying, be the black swan event that a lot of people are sort of expecting, but most the market's not pricing in any swan event because there isn't a swan event yet. There isn't a black swan event yet. So, see how it plays out. Sorry for all the clicking noises. My silent mouse died, so I'm back to using my regular mouse. Next chart is oil. I mentioned yesterday how I thought it was really interesting how we hit this perfectly, this little trend line here yesterday to the T. Today, oil broke higher out of this descending wedge, which is not unexpected. Again, this market dating back to 2021, we've bounced off of this trend line, and we're so close to it still, bouncing off of it many times very recently with head and shoulders looking patterns all over the place. It would not surprise me at all to see this, to see a WTI crude oil crack to the downside at this point. I don't know about you, but here in Florida where I am, gas has been cheaper than it's been in a very long time. And although that's only anecdotal evidence, I might not be the only one seeing that. Because of the frequency of the knocks on this door here, with every knock, any trend line gets weaker. And so it still won't surprise me at all if we return to this line and break through it in the very near future. Dr. Copper, known for having a PhD in economics, as many people say, the price of copper can really foresee events. People say it has a PhD in economics because this is one of those markets that is a real market. It's how much people are actually paying for copper, and copper is involved with, infrastructure, cars, electronics, so many things. It's a very great place to see where things are, where things might be headed. This caught my eye today only because, as you can see, if you know anything about chart patterns, I don't even need to say what I'm seeing here. But we're here. We're on this right shoulder of this head and shoulders pattern on copper. Highly interesting. There are so many technical chart pattern setups that it just makes me see in the crystal ball that something big is coming. Some big black swan event is coming. It's coming. I can see the black swans. They're filling my crystal ball one after another. One black swan, potential black swan that I've been talking about, looking like it's leaving the scene from us for a little bit. There's no question about it now. We're no longer in the breakdown of this head and shoulders top in wood, which is another great leading indicator what's going on with the wood market from a purely technical chart pattern basis. We're above the line now, and so this gives a lot less weight to the idea that wood could head down to that target I had previously talked about of $73. Last chart of the day I want to bring up is actually Nissan stock. If you've been following the show for a while, you might know that I have 5% of my own portfolio currently in Nissan stock. I see this as a definition perfect example of a undervalued value stock of that Ben Graham might buy himself. I would not be surprised to see this in Michael Burry's portfolio or Warren Buffett's portfolio, as they are both primary also value investors. What it boils down to is that if the company were to liquidate today, the stockholders would make a bunch of money based on the current price of $5.33 as it is today. And so that's like an absolute no-brainer for a stock. And, the company, it sounds like, from a qualitative standpoint, the CEO has accepted a 50% reduction of their own pay, and they're cutting down their producing operations because they're not seeing cars selling as much as they had been expecting. So they're making cuts, which is great for a company, and the balance sheet is healthy. So I see nothing wrong with this company. I'm really excited to hold its stock. And by the way, if you had bought it down here at the very bottom at 475 and simply held it to this its bounce off of that, you would have made a 20% profit in only a matter of a week. I did accumulate in this area, but I've been accumulating for a while and I'm holding it. I'm planning to sell at what I consider to be a fair, extremely cheap value price of around $9 is my target selling price. Anything under $7 to me is a bargain deal based on Ben Graham's work. But anyway, I just wanted to bring up the chart today because we've had this pretty clear descending wedge in the price. And today, actually, we're sitting on this line here. And that's like a great setup to me. If I was purely a chartist, if I was purely a day trader, I would see this pattern as a great opportunity. Combine that with what I know about the valuation of this company. I mean, it seems like a great place to be, in my opinion. But that's just me and my crystal ball, and that's all for me and my crystal ball. I hope you enjoyed, and we'll see you next time. Robschild.